Next up, we have Felix Fernandez and Dr. Tobias Setz on the practical risk management for cryptocurrencies. And without further ado, I suggest we start.
Okay.
Great to have you here. Enjoy.
Yeah, thank you very much for the introduction. Can you see my slides now? I've shared my screen. Excellent. Okay, so good evening to everybody and welcome to this presentation about practical risk management for crypto investments. A little bit about myself. My background is mainly in traditional finance. I've been working around about 20 years for Deutsche Börse Group and Eurex, so I know the market operator side quite well and exchange client business as well. Since 2016, I founded together with Tobias OpenMetrics Solutions. He will explain a little bit later more in detail what we do there. OpenMetrics is a spin-off from ETH Zurich, focused on risk management technology. Since January this year, I joined the 21E6 initiative. We are convinced that this is really quite a, let's say, phenomenal approach to looking at the market from a broader perspective into different investment opportunities. So a little bit about the, let me see if I can switch the slide. Here we are. So a little bit about the team. So, and the company, so 21E6 Capital AG in formation. So we're currently in the process of creating the company as a startup. We are focusing on investment advisory for crypto assets. And we will launch our flagship product, which will be a crypto fund of fund by summer this year. And as you can see from the team structure, we have here a very diverse team with renowned experts from the crypto universe and finance, and with deep academic roots. So on one side, the Frankfurt School Blockchain Center, on the other side, also our connection to ETH and everything which is related to the, if you want, statistical mathematical foundation, how to run a fund. A little bit about risk management and why risk management matters. So a little bit generic perception is that risk management is often seen more as an obligation and not necessarily as an opportunity. In contrast, so where you see new investment ideas, so be it thematic, algorithmic, sentiment-based, AI-driven, this has been thriving across the industry, and basically every new idea is then seen as a potential opportunity on how to generate performance. So what is the explanation for that? So why is risk management not in the focus? I think that one possible explanation is that risk management costs money. But as well know, there is no free lunch in finance. So the focus on risk management creates, let's say, some added value, which we should always consider when running any investment solution. So maybe the two main reasons from my perspective why we should care, why we should put effort in risk management. Also, first and foremost, it protects the assets of our clients. But second, it keeps us in business. Because you can observe many funds, many initiatives which run out of business once they have experienced some severe drawdowns and basically are in a situation that is impossible to recover. Why I show this chart? I mean, all of you are aware of the recent market moves where you can observe that the market dropped so the Bitcoin price dropped within a very short time frame by roughly 40 percentage points or 43 percentage points in 12 days. Now, important here is the dimension or dimensionality. Returns in crypto space and crypto world cannot be compared one-to-one with other asset classes, but still, from a perception, many people do. So if you would scale down, which is roughly a good approximation for adjusting it to equity returns. So if you would scale down all the figures here in the crypto space by a factor of 10, you would be in the range of equities, where a drawdown of 4%, well, no one would really care, but you would have quite an attractive risk-return perspective. And this is one of the main KPIs we're looking at, and also, of course, the drawdowns in terms of capital protection. And also an important point here is that only a combination of strategic and tactical asset allocation provides a reasonable, let's say, risk control, especially for fast market moves. When we build an investment universe, we look at the different strategies we combine into a portfolio. I don't want to go into much depth here, but important is that we can add value by diversifying the portfolio. Second, the strategic asset allocation takes care of combining market exposure with, let's say, low market exposure or non-market exposure, depending what you're choosing, which is point 1, 2, and 3 here, where we can say an optimal market portfolio, optimal market neutral portfolio, and an optimal market portfolio combined provide the risk allocation space which you want to see, and gives you the opportunity to position yourself in this field where you would like to be in terms from an investor perspective. Last but not least, with some concrete numbers, you can see here this space which is showing a selection of a naive crypto fund where there are roughly 300 funds included. On the upper right corner and in the bottom left corner, you see a market neutral portfolio. And basically what we can do with the right strategic asset allocation is to find a spot on this line which provides us the risk return that we want to have and the drawdown profiles that we want to have. And this is important to understand that the dimensionality, correct strategic asset allocation, and then on top, and this is a separate topic we cannot dive today into much, is a tactical asset allocation, but Tobias will allude a little bit on the theory behind the tactical asset allocation. And yeah, last but not least, given the short time frame, I would stop here and hand over to Tobias. If you have any questions, which probably will arise in this after this short presentation, feel free to contact me. Okay. I think, okay, that's fine, Tobias. Now I think you can, do I have to stop you?
I will share my screen now. Share. And so, can you see the slides in full screen? Okay, then I will continue the presentation with a bit more focus on our risk management methodology. Maybe a little bit about myself. My background is rather academic. I had my education here in Zurich at the ETH Zurich in the Institute of Theoretical Physics, where we were always engaged with industry to look for interesting developments in the field of statistics that they could use for their risk management. Primarily with pension funds to bring quantitative models to their strategic and tactical asset management. So basically, as Felix already mentioned it, our roots are quite academic. The development started already in 2005, mainly with the publication of or the founding of the OpenMetrics Association. The OpenMetrics Association provides a lot of software libraries that cover many of the common quantitative risk management methodologies that are used. And I was myself, so it's an open source project in OR, and I was myself engaged for many years in this project, and still officially the maintainer of this very large software library universe. So based on that, and in collaboration with pension funds here, we were thinking about a methodology that we could really use in investment committees so quantitative input for investment committees on how to allocate their capital into the different markets. And based on that, we founded OpenMetrics in October 2016. So maybe a bit about our philosophy. So we don't claim that we have somehow the holy grail to predict the future. And we propose actually a different way of doing risk management, which is somehow known under the under nowcast. So this is not, what we are doing is not really a forecast. It can be better explained maybe with the word nowcast, because instead of trying to look into future, we rather propose to have a very fast sensor system that reacts on the input as it arrives, similar as self-driving cars or any self-regulating sensor systems. The reason why we do that, that's a little bit described on top. So usually, so every real-world system is a combination of a deterministic part and a random part. Sometimes the deterministic part is stronger, and somehow the random components are stronger. So if we, for example, look at our planetary orbits, they are very much deterministic, so they can be predicted a couple of million years into the future. But even there, at some point, it starts to break down, which is not a problem because we only need to predict it for a couple of years and then we can predict it again. If we then, for example, look at the weather, there the deterministic part is not that strong anymore. So we have much more random, we have a much stronger random component in the development of the weather, which limits the possible prediction period. So for the weather, it's a couple of days. It might be possible at some point to have accurate predictions up to 10 days, but that's probably the maximum that we will ever see. And if a physical system can be well described with formulas, we can even calculate that possible prediction period, which is called the so-called Lyapunov of time. And that's kind of a hard barrier that's very hard to cross to make prediction over this Lyapunov of time. Now, the question is, what about financial markets? Actually, there is academic work about that, about the Lyapunov of time for financial markets. It's not so extensive as for physical systems, but one might assume that the random components are even stronger as for the weather. We don't have that very nice physical system that we can use to describe the weather for financial markets. So we must assume that the possible prediction period is probably quite low, maybe seconds, maybe in the best case a couple of days, but that's probably it. And if we are working with pension funds, we usually do not work on high frequency, but rather on a low frequency, on a monthly basis, maybe on a weekly basis, but that's about it. So that's why our system rather focuses on describing the current state of a system and then react on that. For that, we use, I will not go too much into detail here, a so-called Bayesian change point methodology. And this is all published. If you want to go down to the bits, you can always contact me and I can send you a link to the publication where you can look at this in detail. So basically, what we are looking at is the dynamics, the random dynamics that are generating the returns of a certain asset. And if you look at the top, you can see this is the S&P 500 from 1925. And on the bottom is a synthetic index that I created myself with a random generator. It has the same return and the same variance as the S&P 500. Now, if we look at the stability of the dynamic that is generating these indices, we can see that for the S&P 500, there are a lot of structural breaks where the dynamic significantly changes. And this is not the case for the random index that I created myself, because I used a constant random generator that always functions with the same rules. So this methodology can very reliably predict if the underlying dynamic of a certain asset is constant or is significantly changing. And if that happens, if we see significant changes in the dynamic of in the dynamic that generates the returns, we know that we have to take newer observations more into consideration than older observations. So as soon as the dynamics start to break, we look at the newer history, or we give the newer history more weight than the older history in order to calculate risk measures. So what happens if we apply this? So in this chart, you can see at the top a capital-weighted crypto portfolio that consists of Bitcoin, Ethereum, Ripple, Litecoin, and Bitcoin Cash. Of course, the constituents could be changed. And that is the blue curve. And you see it has very high returns, but also the risk parameters are rather high. So the volatility is quite high. And also the maximum drawdowns are rather large. Now, if we use our methodology, that's what you can see, the green curve, where we dynamically hedge our positions into the crypto assets based on the signals that are generated with the help of these structural breaks. Now, the goal is not really to beat the market, and I think that's some kind of misconception that with active risk management, you could beat the market. I think the goals should always be, if the risks are reduced, that they are not as strong reduced as the returns are reduced through the risk management. And the Sharpe is a good ratio for that. So if you apply such a methodology, it is important that the Sharpe does not go down in value. And we see actually the crypto market has quite a high Sharpe. A passive hedge would have a similar Sharpe if you would just hedge these positions passively with 50%. And if we use this dynamic methodology, we can even improve that risk compensation. So that's just about the poor application of the signals. I will now go to the last slide. So here we do this not only for cryptos, but for a basket of equities and cryptos. And the money that is not invested in equities and cryptos, so if we have a hedge position, is then moved into a basket of bonds and precious metals. And as you can see, by just
Gentlemen, 30 seconds to go.
The maximum allocation for cryptos is just 10%. And so just to come to the main message, by adding this 10% to a portfolio of equities, bonds, and precious metals has a huge impact on the return and risk parameters. So to summarize, what this slide should say is that it would make sense for any investor, even if it is only 10%, to add that to his existing mixture of equities, bonds, and precious metals. So I think the time is up for us, and I will give back to Robert.
Thank you. Thank you two very much.